Welcome to Markets Now. I'm Michelle Rook with Mike Zuzulo, Global Commodity Analytics. We're seeing some mixed trading grain and livestock futures this morning in the livestock, cattle setting back, hogs higher. We've got wheat a little bit better, and the row crops have seen a little bit of weakness this morning. And Mike, do you think in terms of the soybeans, we've had a pretty good pullback here now? Is this just harvest pressure, or are these concerns about the Mississippi River and our exports?
Yeah, it's hard, Michelle, to get the market to change course right now in the soybeans, especially when you're hearing the kind of anecdotal yield reports you're hearing east of the Mississippi River and then west of the Mississippi River. It seems like the last week I've heard more bean yields sneaking up as opposed to sneaking down. Between that and, as you say, the Mississippi River, I mean, the Memphis basis for soybeans has just collapsed. I think it's a 180 under right now, and just 2 or 3 weeks ago it was 60 under or 70 under, and we're sitting here with daily moves of almost 60 cents because of this pulling of the basis, and just realizing we're not going to get the demand. And the difference between corn and beans right now is the rail market, is the Mexico purchases of corn. But kind of sticking with beans, I'm a little bit more nervous that if we don't hold this 1256 area for these monthly lows that we put in earlier this week, the market may start to get revved up and try and sell into the idea that the next WASDE report could actually be bearish, price negative for both terms of yield and maybe export demand when it comes to the soy complex.
So if we take out the 1256, Mike, will we go back to that, 1186 contract low, or it was somewhere in that area anyways?
Yeah, I think so. That's really kind of the magnetic draw because that's also really close to the 2021 harvest lows. And if we stay above 200 million bushel carryover and go towards 2.25, which I'm fearful of at this point, given the 70s and 80s that I'm hearing in some of these states for yields, it very much could be that situation. And that's where it goes back to clients in Illinois calling me saying, I got 75 bushel yields. Should I store? Well, if you can get a 1230 or 1240 price, it's still $800 an acre revenue. I can't recommend storing on that kind of mindset, even with that kind of a wide basis.
Yeah. So the corn market, as you mentioned, we've seen prices hold together pretty well here the last couple of weeks, especially when you've got soybeans kind of imploding. The export market, weekly exports this morning kind of picked up, and you mentioned Mexico. Is most of that going to just go on the rail? And so do you think Mexico is going to kind of keep purchasing here? And are we at a level price-wise now that you think we're competitive?
I do think that, Michelle. I think if you could take wheat out of the mix as far as pressuring the corn, I think the corn low may be in at this point, or want to try and be in, because Mexico, as you say, 60+% of the weekly export sales. We don't have to worry as much about the Mississippi River. The other big thing about the corn is those report numbers last week, lowest September 1 stocks in 10 years since 2013, 2014. We've just kind of danced around that because of all these other outside market factors and the soy complex, and obviously the wheat getting caught up in the outside market factors. But I'm watching 490, a close below that on a weekly basis gets you up towards that 493 high back in late August. If you break above 493, 495, you kind of open the upside up. So this is where I think, again, it would make more sense to me, both from a flat price standpoint, yields that I'm hearing in the fields, to store corn and sell beans if you had the option.
So what do you think we need in the WASDE report coming up next week to get that market over $5 and that resistance you just talked about, that 490?
I think we need the world wheat numbers to go down again. And, Coast Cereal came out this morning with another cut, and it wasn't a big cut, but it puts it about 7 million metric tons below USDA's September figures. And I think Australia is on the way down in production. Argentina is on the way down in production. And I think maybe Russia and Ukraine could actually be on the way down in new crop production because they may be cutting acres due to drought. And I think this is an issue where all kind of the needle points on the compass that most of this time of the year, if we're going to get a low, and I expected it in September for wheat, if we're going to get a low, I still think it needs to be drawn from the wheat if we're talking about a big low. But those outside markets keep hammering us, and that relationship between the 2-year bond yield, for instance, and the Bloomberg grain index, it's almost a negative 100% on some of my charts. And that's the causation correlation type discussion. But the bottom line is we tried to rally Wednesday in beans, equities, and feeders, those old demand darlings, and we couldn't maintain it. And I think it was because we started to turn negative in the bonds, the yield started to jump, and the equity started to roll over.
Yeah. When you get China in buying SRW wheat and you really can't rally the market, that is kind of a telltale sign, isn't it?
It really is. And I wrote about this last weekend to clients and subscribers. The two 800-pound gorillas standing on a potential turnaround in 2024 is the Federal Reserve and China. I'm nervous China is not going to make big moves in their economy now. I thought they would in the month of September, but I think maybe they're kind of burrowing down and saying we're in it for the long term. So that leaves us to the Fed becoming neutral. We need the Fed to get neutral, and I'm hoping that if the equities markets do any good at all, it's to change the mindset of the Fed and make them realize we don't really want a recession, do we?
No, absolutely, because of what it'll do to demand. The crop estimates from the European Union that you talked about here this morning, obviously that's kind of bumping up the wheat market here this morning, or, because exports were horrible again for wheat,
Right.
weren't they?
Yes, they really were, and it really does open up the idea that we're going to continue to suffer, and the EU, while it will get more exports out the door to countries that maybe the Ukrainians and Russians can't service anymore, it's going to leave us really high and dry, and this goes right back to the issue of that Mississippi River level as well.
Yeah. I want to circle back around on these outside markets. The 30-year treasury is at levels we haven't seen for like 16 years, back to like 2007. What is all of this telling you about what's going on in the economy, or are we starting to move into recession? Is that what this is signaling?
Yes, it is, in my opinion. A terrific economist, Ed Yardeni, who came out with the term bond vigilantes, was back in the news again this month because of what the yield curve is doing and what the 30-year Treasury is doing. And in Great Britain, for instance, right now, Michelle, the longer dated Treasury yields, they're at the highest since the late 1990s at this point. And what it's doing is it's pulling everything to a risk-off mindset. And I think we're coming to a screeching halt in terms of consumption. That's my fear. And the bond market supports that, in my opinion. So when we talk about the idea of consumption tapering off versus falling off a cliff, that's my biggest fear. That's why I've been nervous about a Q4 recession, especially as it goes back to the meat sector and the consumption side of the equation.
Yeah, that is why the cattle markets have been down here recently, right? Even
I
though fundamentals still look good on the supply side.
Yeah, exactly. The funds versus the fundamentals is what you can see very clearly, I think, in the cattle market, is that you see that the funds do not want to participate in the long demand mindset, long feeders, short corn mindset anymore, for instance. But the fundamentals have not caught up with that. And they typically don't, because we saw this in 2014, 2015. We went down in feeders from about 245 down to 190, 195 area by the time we got to February of 2015. And then we rallied back for a double top, and then we pretty much slid from spring 2015 all the way into the end of the year. That was with retention. That was with animals being held back. So that's what I've really been talking to ranchers about, is you've got a feed issue now. If that corn market starts to turn, and then if the feeders also start to go down, what are you going to do in the springtime for your fat sales?
Yeah. Time to become defensive, that's for sure. That hog market back up here today, we had strong weekly exports over 42,000 metric tons. So this is kind of a demand pull here this morning, you think, or a demand rally?
Yeah, I think so. And you also have the cash index that's sitting at a really nice premium, as October is within about 10 days of going off the board. And so if that cutout can hold in on the pork side, given these export sales, I think that futures market may want to try and come up to the cash index. So kind of watching for that. It is National Pork Month, so we're going to see a lot more featuring, I think. And that kind of, along with the packer margins being green instead of red in the cattle side, supports the idea that dips could be bought here.
Yeah, we got beat up pretty good after the hog and pig report, though.
And rightfully so.
Wow. Yeah, that got a little ugly there. All right. Thanks for joining us, Mike Zuzulo, Global Commodity Analytics, and that's Markets Now.